This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
There's a lot of gray area in the 1031 exchange world, and you get a lot of opinions, but instead of saying this is an opinion, the way they state it, it sounds like fact. So people, probably the biggest area people get hung up on is how long do I have to hold title to property? And they'll get answers from 1 year to 1 year and 1 day to 18 months to 24 months. And they're like, well, what is it?
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, this is Augustino. One of the primary reasons why investors love real estate is because of the huge tax benefits. Now, specifically, the 1031 exchange that's a section in the IRS tax code that allows investors to defer paying capital gains taxes. Now, if you're a real estate investor, this is a great opportunity to keep the gains yourself and keep them out of the tax man's coffers, right? Because we know what happens when that happens, it usually gets wasted. Now, our next guest knows all about this. Now, he's been working with investors as a qualified 1031 intermediary for over 34 years. Now, he provides specific steps and useful information for investors considering an exchange to minimize their tax hit on their gains. Now, he is the president of the Exeter Group of companies and has been in the banking, trust, and fiduciary services industry since 1980. Now, he began specializing in real estate tax strategies in 1985 with an emphasis on 1031 and 1033 exchanges as well as self-directed IRAs. Now, with all that, I'd like to welcome Bill Exeter to the show. Bill, thanks for coming on, man.
My pleasure. Thanks for having us.
You bet. Now, guys, if you like what Bill has to say, you can reach him via the contact page at exeter1031.com. We'll include a link in the description. Okay, Bill, go ahead and tell listeners a little bit about your journey. How'd you get started?
Good question. I was controller of a bank in Los Angeles. This is back in the early 80s. And the chairman of the board had decided, let's start a 1031 exchange company. And outside counsel said, let's not have the escrow subsidiary run it. And with that, they threw it at me. And at that point, I had no idea what a 1031 exchange was. And about 2.5 months later, UCLA had a 2.5-day cooperative extension program just on 1031 exchanges. And I took that. And from there, my career kind of did a left turn. And I've always been in the trust services world. So it's kind of one foot in banking. But the rest really is 1031 exchanges and that type of product.
Right, because I think 1031, the whole concept is fairly new, right? I think, didn't it come out in the 80s or 70s or something?
It really took off in the 80s. The actual tax code, which way back when was in Section 1031, so it had been a kind of a metamorphosis over time. But it actually is 100 years old as of last year.
Oh, wow.
So we've had a long run. But it was the 86 Tax Act that really took a lot of things away from investors. So the 1031 exchange is really something that was quiet, wasn't that well known until the 86 Tax Act.
Right. And I think part of it, too, is that even investors prior to that 86 Tax Act, there wasn't really a mechanism to control it either, right? I mean, maybe there was, I don't know. But I imagine that would have been a little bit, a little more hairy, right?
That's it. That's why I have no hair. Yeah, but you're absolutely right. Back then, it was kind of the wild, wild west. Most exchanges were concurrent. So you'd sell your relinquished property, close your replacement property all on a concurrent basis. I know one escrow officer that had a client that did one sale and 86 purchases and closed concurrently. And That was before computers, so I don't know how she possibly did that, but that's what you saw, a lot of those type of transactions before 86.
Yeah. Now, for those that are not entirely sure, what maybe you can explain 1031 at a very high level, like what is it and why does it matter? Why should people care?
Sure. Well, probably the best way to describe it is an example. So you might have bought a single family house years ago, and maybe you lived in it originally, maybe you rented it, or if you lived in it at some point, you got relocated, you decided to rent it out. So people sometimes go into it on purpose, and other times become an accidental landlord. And then they decide, hey, I really like this. I love real estate. Then they decide, let's sell the single family. Maybe we go to a duplex or fourplex or what have you, and diversify by numbers of properties or diversify by asset classes. Then, of course, they sit down with their CPA, hopefully, and go through the numbers. And that's when they find out, oh, my God, they're going to have all of this tax liability that they're going to have to pay. And hopefully that's when the CPA will recommend a 1031 exchange. So the 1031 in that case would allow them to sell the single family, defer their federal and state taxes by reinvesting in other replacement properties. So it's really a tax deferral strategy that keeps your equity, all of your cash in your pocket as the investor, which makes it easier to trade up in value. If you had to write a check and pay a third of your profit to the federal and state government every time, it's much more difficult to reinvest and trade up in value. So it's all about selling, reinvesting, deferring your tax, keeping everything in your pocket.
Right. So, and this is very, very powerful because, to your point, you're able to take these gains, roll it into the next deal, right? So you go from deal to deal to deal, every time getting a little bump there, conceivably, if you're buying your stuff right, and you're applying. I guess you can say you're putting, quote, more money down because the government's not stealing half of it, right? So you get to do, well, you're deferring it though, because at the end, when you do go to liquidate this thing, you will eventually have to pay the piper, if that's what you choose. Because if you do it right, though, you're basically pulling off cash flow the entire time, right? So and cash flow is taxed differently.
Absolutely. So certainly, most people are looking for cash flow, so they're reinvesting in something that provides cash flow, and that's ordinary income. But in theory, too, the value of your investments are growing and building, and then exactly what you said, you can refinance, pull the cash out, and go buy another property. And that's all tax deferred. That does not trigger a tax consequence. Some investors will get to the point where they're retired and they want to start cashing in and living off their assets or investments. That's certainly okay. And at that point, that's when you start paying your taxes. Others who may not need to cash in and can live off the cash flow, they're not going to sell. They're going to keep the property until they pass on. And when they pass on, they're going to leave that to hopefully their kids or their grandkids or what have you. And they will get a step up in cost basis, which means capital gain goes away, depreciation recapture goes away, and the heirs pay no capital gain or depreciation recapture taxes.
So it works out great in that perspective, so.
We call it swap until you drop.
It sounds a little disturbing, but yeah, I get it. I understand how why do we do this, right? Of course, it's to build some legacy wealth, right? It's ultimately what it is, right? So
absolutely, yeah.
But it's important to note that to do that strategy, you really have to have either a good trust or a good will set up. So it doesn't happen by default, because if you don't have that stuff set up, it will end up in some sort of, what's the word I'm looking for? It'll end up in...
probate.
Probate, thank you. Ends up in probate. And then that's a whole ball of wax that you don't want to get into, because it's terrible. That's a terrible, terrible scenario. And the chances of winning in probate are, very, very low over time. So, you're better off, if and this is my PSA for the show here, if you do have real estate, please go ahead, talk to an attorney about getting a decent will or trust or some sort of strategy in case something happens to you. It's very, very important that you do that for your family, so your family's well-being.
Yeah, you never know when something's going to happen, and if you don't have that trust in place, you end up in probate whether you like it or not.
Right, and there's nothing you can do about it. It's terrible, but you're absolutely right. Hey, Augustino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me. So I heard of talk about people, or was this new administration blowing away the 1031. Have you seen anything that demonstrates that this might actually happen?
Yeah, in fact, they tried last year. So 2020 kind of came out at the end of 2020, but really 2021. He included it in his Green Book. The Green Book is kind of a wish list. People call it his budget, but it's really what he wants to have happen. He won't get everything that's in the Green Book, but it was included in that. And the proposal was to cap the amount of taxable gain you can defer in a given tax year. And it was capped at $500,000 per person per year. So a husband and wife could defer $1 million total. Now that was, we were able to get that not included or excluded from the bill. So that was our goal. We want to get it out of the bill or hopefully prevent it from being included in the bill. And we were able to do that. He has included it in this year, 2022's. Actually, it's issued in this year, but it's for 2023's budget or Green Book. And so he included the same exact proposal, which is to limit or cap the capital gain at $500,000. Because last year we did a lot of networking and educational programs for members of Congress to educate them on what is a 1031, how does it work, and why it would be a really horrible thing to get rid of it or to limit it. This year, because of the political environment we're in, we don't think there's any risk of that passing. So you're not going to see the same type of anxiety this year for that kind of proposal. We're just keeping our eye on it just in case.
Right. I mean, most folks in Congress actually have real estate, don't they?
A lot of them do, and Pelosi made a ton of money in real estate.
Yeah. Yeah. So I can't even imagine that these people would support anything like that. I don't know if it's just for posturing or what. I mean, it's very strange that they would even do that. But I mean, if you look at what Congress does, on both sides of the aisle, they're really big on acquiring real estate and basically using that law to their advantage. So
absolutely, yeah.
It'd be very odd for them to try to blow it away. So it's very strange. But okay, well that's good. So it doesn't seem like in the short term anyway, it might be going anywhere. So that's good news. Good news. So now, what are the steps that a regular everyday investor should take when they're trying to enter into an exchange? And so let's say an individual, they bought a property, maybe they bought their first one, looks like they're going to make $1 million on this thing. They bought it for $2 million, they might sell it for $3 million, they get to a nice little chunk of change there. How do they avoid paying the tax on that?
Good question. The one thing I can see a lot of investors don't do that they really should do is, step one, find out what the value of your property is. Talk to a broker, get a broker's price opinion or something like that. So you kind of have an idea of what you think you'll sell it for. But most importantly, take that information, go to your tax advisor. I see so many investors that make a kind of a off-the-cuff decision to do a 1031 exchange because they hear it's the thing to do. They don't want to pay the tax, and they do it. And then later they find they should have done something a little different. It may have been, let's do a partial exchange because we have some loss carry forwards. We may have some suspended passive activity losses that we can use to offset some gain. There's all sorts of reasons you may not want to do a full exchange or even an exchange at all. So meet with your tax advisor first. Once you get past that and you decide the 1031 exchange is the right choice for you, then you want to make sure you get the 1031 exchange set up and in place before closing. The key is the purchase and sale agreement has to be assigned to the qualified intermediary before closing, so that way it prevents them from access to the funds and it defers the taxable gain. If they don't have the 1031 exchange in place, even if they tell the closing agent, don't worry, don't disperse the funds, I'm going to do a 1031 exchange, the fact that it closes triggers their taxable gain. So it's all about getting the exchange set up before closing, otherwise there's no way to go back and fix it.
Yeah, and it's worth noting too, well, the way I like to put it, if that money touches your hands, it's taxed, right? So by putting it into a separate trust, if you will, I guess it's essentially what it is, right? It's a trust, I guess, isn't it? But by setting it up there, it's never touching you. It's basically a third party that's handling that transaction, the cash net transaction.
Absolutely.
So good. So now, what does it mean to trade then a like kind exchange? And there's that terminology. Maybe we can explain that a little bit.
Yeah, there's really two two terminologies there that are kind of intertwined. One is qualified use, one is like kind. And it is amazing how much misinformation is out there. And it's not necessarily on purpose. It just, we get people who say I called and talked to 3 or 4 or 5 companies and I got, 3 or 5 or whatever answers, and I'm completely confused as to what needs to be done. And the reason for that is there's a lot of gray area in the 1031 exchange world, and you get a lot of opinions. But instead of saying this is an opinion, the way they state it, it sounds like fact. So probably the biggest area people get hung up on is how long do I have to hold title to property? And they'll get answers from 1 year to 1 year and 1 day to 18 months to 24 months. And they're like, well, what is it? And so the qualified use really means whatever you sell, whatever you buy has to be held for rental, investment, or business use. Simple as that. If you're buying something and your intent is to buy it and then do something to the property, if you're rehabbing, if you're fixing it up and then you're going to sell, you're holding for sale, you're flipping or rehabbing, that's not going to qualify for 1031 exchange. So anything held for sale doesn't qualify. Anything bought for rental or investment does qualify. So it's all about holding and showing intent. That's the critical part. So if you get audited, it doesn't matter how long you've held it or how long you haven't held it. It all boils down to, can you prove you intended to hold it for rental, investment, or business use? And then like kind, it's amazing how many people think that still means condo for condo, apartment for apartment, etc. And that is not true. Like kind simply means you've sold a real estate asset, you have to buy a real estate asset. So it can include things you wouldn't even think of, like air rights, water rights, mineral rights, oil and gas interests, and things like that. So it's a very broad definition. As long as you're selling and then buying real estate of some type, and it's held for rental, investment, or business use, you're in great shape.
Nice. So you can sell off your mineral rights, take those gains, and put it into a multifamily.
Absolutely.
Yeah. Great. Beautiful. Yeah. So I've heard that before, where people think like kind is exactly what you just said. I can only buy. I sold a condo. Okay, I can only buy a condo. I can't buy a single family home. I can't buy multifamily, but that's certainly not the case. Yeah. Excellent. So, one of the things that, obviously you've been doing this for a very long time, and one of the things that I'm really big on is finding the right partners, building the right team around you. So, one of the things that we have on the team is someone that knows a little bit about 1031 exchanges and how to handle it, our CPA, right? He's a real estate guy himself, right? So, what sort of advice do you have on folks that are, I guess, how do you ensure, I guess is probably the best way to put it, they have the right person for the job? I mean, because a lot of these folks, they don't really understand half the stuff, and they think they do, but they really don't. Like, what should those folks do?
Good question. I'm glad you brought up the concept of a team, because that's what it's all about. And real estate investors, I think they make 2 mistakes up front. One is when they buy real estate, they don't have their exit strategy in mind. And when they're buying, you really need to buy, but you need to know what your exit strategy is, because how do you know when you want to get out? How do you know what your trigger point is? Why are you even buying this? So you need to know what your exit strategy is. And number 2, you got to have your team, because stuff happens. And when things happen at the last minute, you got to have a team you can quickly call and resolve the issues. So, you mentioned CPA, your attorney, your real estate closing agent, whether it be escrow, title, or closing attorney, a good real estate agent that really knows what you are doing and understands investment property, qualified intermediary if you're going to do 1031 exchanges, etc. Get your team together before you even buy. That way you've got it, and then if something throws you a curveball, you've got the team that can help you out of that mess. And we get calls all the time where they'll say, my tax advisor doesn't know what real estate's all about. So interview the people. Don't ask them yes or no questions. Ask them open-ended questions. Clients who are asking for CPAs that know 1031 exchanges, don't ask them, have you done 1031 exchanges? Of course, they're going to say yes. But ask more open-ended questions like, what is the most difficult transaction you've ever worked on? What's the largest transaction you've worked on? And things like that. So they have to expand on the answer. You'll figure out who knows what they're talking about.
I want to take a pause from today's show to share something that I've been encountering. As I speak to many investors, there's this concern. And the concern is centered around the inflation we've been experiencing and the devaluation of our currency. Now, we've seen some of the highest inflationary periods over the past 30 years. That's up over 8%. Economists actually believe that inflation is closer to 20%. Some say it's even more. Now, what does this mean for you? Well, it means that money that is sitting in your bank account or self-directed IRA that's not invested in physical assets that hedge against inflation are losing buying power. That means that every minute, every second, that dollar is becoming less valuable. You see this every day. You see this in the groceries you buy, the gasoline you buy, everyday items that you're buying on a daily basis are becoming more and more expensive, and you're using a less powerful dollar to buy these items, meaning that dollar is losing value if it isn't put into a property that produces cash flow, just like real estate does. Now, our team here at Bulletproof Cashflow has put together a series of weekly webinars that cover real estate investing like multifamily, net lease, and real estate development. Now, these are purely educational webinars. In these webinars, we talk about why real estate offers a powerful opportunity right now and why it makes sense to invest in these assets today. So, if you're interested in real estate or want to have the opportunity to get involved as a hedge against inflation yourself, I encourage you to go to bulletproofcashflow.com/webinars. That's bulletproofcashflow.com/webinars. Now you go there, these webinars are 45 minutes and they cover different topics every week. We go over the things you need to know to avoid some of the common pitfalls when it comes to investing while getting you prepared to invest your paper dollars into a real physical asset. Now, if you can't make the webinars, just go ahead and register and we will send you a recording that you can watch at any time. And by the way, these webinars are entirely free. There's no cost to you. This is just something that we do to educate our folks out there. So if you're enjoying this episode, please like and subscribe to Bulletproof Cashflow. It helps the channel tremendously when you do. Now let's go ahead and get back to the show. Yeah, I think part of it is that whenever you're assembling your team, you have to make sure you have the right people on that team. And don't be afraid not to hire somebody just because they're sitting in front of you, right? You'll save a whole lot more money not bringing on that person. Whole lot of time, a whole lot of heartache. You save a whole lot just by not hiring them.
That is so true.
Yeah, that's right. Something you mentioned about exit strategy. I'm working on a deal right now where there's going to be an exchange component, but I'd love to peel off some cash. I think, is that called like a partial exchange or something like that, right?
Absolutely right. Yep.
So maybe can you explain a little bit about how that works and what are some of the implications, the pluses and minuses with something like that?
Sure. In fact, I'm glad you asked that question too, because there's a lot of misinformation out there on the internet as well. People don't mean to do it, but what they say is things like you have to trade equal or up in value. You have to.
Yeah, I heard that one. Yeah.
And it's like, well, that's true if you want to defer all of your taxes. But there's nothing wrong with a partial 1031 exchange. Some people do it to trade down in value. Some people do it to reduce the amount of their outstanding debt. Some people do it because, it's the old adage, we're real estate rich and cash poor. They want to generate a little cash position. So when you sell and you do a 1031 exchange, typically if you sell for $1 million, you're going to buy for $1 million or greater. So you trade equal or up in value and you defer all of your taxes. But if you sell for $1 million, you could certainly buy for $900,000. You've traded down by $100,000. Of course, I'm ignoring closing costs, but that $100,000 would be taxable. Does not hurt the 1031 exchange. It just means you're going to pay some tax. And most people do it to create some liquidity.
Right. And really, if you already have, some tax write-offs from other assets, then conceivably, you're still I think you may still get nailed on that $100,000, but it won't be nearly what it would be if you were at a W-2 job. Not even close, right?
True, absolutely. And you may have, if you make too much money, you can't always deduct depreciation and losses from real estate. So you may have some suspended passive activity losses. Maybe you sold something else a few years ago that created a capital loss. There's all sorts of possibilities that you could use to offset some of your gain. The 2017 Tax Act had bonus depreciation, 179 write-offs. There's cost segregation opportunities. So there's other things as well that could be used to offset some of the gain. So that's why meeting with your tax advisor is so critical.
Yeah, absolutely. Now, what sort of trends are you seeing? Aside from, obviously, we talked a little bit about not canceling 1031, which is huge. Are you seeing any other trends in the exchange space these days? Is it pretty much still like just, pretty stable?
I'd say it's pretty stable, but it has gone crazy. Our volume has exploded. I mean, everyone's trying to reposition. You still have kind of pent-up demand coming out of COVID. You have a lot of cash that's still out there in the market. Even though rates have gone up, and people are talking about, oh my gosh, rates have hit 5%, 6%, what have you. Those are still phenomenally low interest rates compared to history. When I got into the 1031 exchange business in the early 80s, mortgage rates were 16, 17, and 18%, and people still did deals. So you could still do stuff. And I think because of all of that, and then the political uncertainty where the Biden administration is proposing to cap 1031 exchanges, and all of that swirling together with the economy, people are just repositioning, selling, and doing different things. So I wouldn't say I see any specific trend because there are just all sorts of types of transactions happening, but there's a lot of activity out there.
Right. Yeah. No. And we're seeing the same thing. It's funny that it was kind of like it was in hyper mode before, I don't know, I'd say 8 months ago. Now it's not hyper, but still very active. It's still very active. We're seeing it. I speak to a lot of developers like myself, and it sounds like there's a lot of developer type of deals that are becoming front and center. I'm not saying that regular assets are trading, like multifamily, for instance, but other people are getting into development stuff. And in the same vein, it sounds to me like if someone did have a multifamily and they wanted to roll it into a development deal, as if it's both syndicated, easy to do, right? That's again, like kind exchange, right? Or would that make sense?
Yeah, then it kind of depends on how they structure it. So, of course, with development deals or just syndications in general, you'll get a lot of them that are structured with some type of a limited partnership or an LLC with multiple members, so it's treated as a partnership. In those cases, what you're really buying into is a partnership interest, so it won't qualify for 1031 exchange treatment. But then you get those that do want to accept 1031 exchange funds, and there's different ways to do it. The big syndications where they just buy and then sell it off are usually done through Delaware statutory trust today. Pre-2008, they were tenant in common arrangements. Or you'll get some syndicators that do an LLC for those who want to buy in with just out-of-pocket cash, and then they'll have some tenant in common interest for those who want a 1031 exchange into it.
Right. Nice. So I know you touched on this, but maybe we should probably go a little deeper in terms of timeline. Like, what does the timeline typically look like for an exchange after a property is closed? Like, what does it typically look like?
Good question. In fact, I think the most important thing to note is everything gets triggered on the close of your sale transaction, or if you're doing a reverse exchange, on the close of your purchase transaction. There's a lot of folks that will call us and say, I think it's supposed to be the date I signed the contract or the day we open escrow or something like that. And it's none of those. It's closing. So when you close on the sale, the buyer has the right to the property. That's the closing date, and that triggers your deadlines. Then you've got 45 calendar days to identify what you're going to buy. That's the tough part. I mean, especially in today's market, trying to find something in 45 days is really difficult. So if you can get things lined up ahead of time, somehow control the property before you sell her, it buys you some flexibility there. After the 45 days, you have an additional 135 days to actually complete your 1031 exchange. That's a total of 180 days.
But it sounds like in those cases, those tight timelines, a reverse 1031 may actually be a better deal, right?
The reverse exchange really takes a lot of the risk out of the process. Having said that, they're also a lot more complicated. There's more costs involved. So if you are in a position to pay all cash for your replacement property, absolutely. Reverse exchange is complicated but very doable. If there's a lender involved, most lenders will not cooperate with a reverse 1031 exchange. So we'd have to look at whether we can take title to the relinquished property they're trying to sell. If they're putting enough cash equity down, that's still a possibility. Other than that, reverse exchanges are just a lot more complicated. So that's about 3% of our transaction volume, which kind of shows you what the complications do to the volume.
Yeah. It's funny. There was a deal that we were looking at doing. It was a high rise. here in the Midwest, and after a very brutal bidding process and all that fun stuff, the seller was unwilling to sell. Well, I guess to put it nicely, they're willing to sell the asset, but they want to be able to cancel it at any given moment. I'm like, well, I mean, so there's no deal here then, is there? You know, and so it sounded like they're going to do like this reverse 1031, and I guess they lined up to your point, they lined up a lender that would basically hang on to the property until the 1031 is completed. I guess is what it sounds like, right? So it's almost like there's a temporary holder in the middle there, right? Very expensive. It's expensive, but it's doable, right?
Exactly. Yep, absolutely. Yeah, there's a parking arrangement where in most cases, the replacement property will be acquired and held or quote unquote parked with an exchange accommodation title holder. So most exchange companies will do those. They set up what we call the EAT, the exchange accommodation title holder. It acquires and holds title to the property, and then you have 180 days to sell your current asset.
Nice. Now, what happens if that investor can't complete the closing of the exchange in that given time frame? Look, what happens to it?
Good question. I'm going to back up a little bit. If they're doing a regular forward exchange, they're selling first and buying second. If they can't identify or maybe they identify and can't close on it for whatever reason, if they don't acquire the properties within those deadlines, then it becomes a taxable transaction. There's no penalty for an incomplete or failed 1031 exchange, although I suppose paying the taxes is kind of a penalty. But all they got to do is pay the normal taxes they would have paid anyways. In a reverse exchange, they're buying first, they haven't sold anything. So although in this market it's probably unlikely, but if they can't sell their asset, it's a failed reverse exchange. But in that case, they haven't sold anything, so there's no tax consequence.
Nice. Yeah, I mean, it's like I said, I guess the downside to being the guy who's just rolling it forward is easy. It's the reverse one sounds like has a little more risk associated with it, right? So, but good. All right. Well, so now what would you what would you do then in the case of a swap? That what's it called? A drop and swap, where I guess are you able to even do those? Are you familiar with the whole drop and swap type scenario? Have you heard of this?
Yes, absolutely. That's a really good question because that's one of the most common issues or questions we get quite a bit. And for the listeners who don't know, that's where you own your property in some type of a partnership. It could be a general partnership, limited partnership, LLC treated as a partnership. And they're going to sell the asset, but they don't want to stay together. The underlying partners or members want to go different directions. The one thing they have to remember is they don't own real estate. The entity owns the real estate. The partners are just going to get a cash distribution. So if they just sell it at an entity level, distribute the cash, the partners can't do a 1031 exchange. So the question is, how do you address that? Well, if you've got enough time to plan, and enough time is probably 2 years in a perfect world, you would drop the property out of the partnership by deeding it to the individual partners. They would take title as tenants in common. That's the drop. And then when you decide to sell 2 years later after a seasoning period, then when you sell, that's your 1031 exchange or your swap. So you drop it out and then you swap it later. So it's a drop and swap. In a lot of cases, they don't want to wait 2 years. So then the question is, can you drop it out today, sell it tomorrow, and do a 1031 exchange? And there's some risk with that. There's a couple of court cases, a couple of them allowed a drop and swap and a couple did not allow a drop and swap. And the risks and challenges are, number one of the cases they rely upon was a general partnership. And in today's world, most of the partnerships are an LLC. So it's a different legal entity that may be problematic. Some of the cases that people look at all the time are California cases. And California has a new partnership act. So we assume the court would rule the same way, but that's no guarantee. So we try to recommend the client not do a drop and swap, work with their advisors, their attorney and CPA, and come up with a different plan if possible. It might be some kind of a redemption agreement. or you buy out the partners who don't want a 1031 exchange. There's probably a ton of different solutions depending on the goals and objectives. But a good question, if you own property inside of an entity, now's the time to think about your exit strategy and then talk to your legal and tax advisors to see what you need to do today to get ready for the future.
Yeah, excellent. Now, here's a great question when it comes to the actual company itself. There's a lot of companies out there that do those 1031 exchanges. I know you guys do it too. Why does it matter if they go to, like, say, go to you versus equity trust? How do these different companies compete? How do they differentiate themselves? Good
question. We've got an article out there too that qualified intermediaries are not created equal. And it's people don't realize that. I think most people assume that a qualified intermediary is qualified, is licensed, is regulated, etc. And the 1031 exchange industry has no licensing or regulatory body. So virtually all qualified intermediaries have no regulatory oversight. We do because we chose a number of years ago that we wanted to be regulated. Now, the industry doesn't have the capability to regulate, so we decided if we want to be regulated, you have to go down a different path. So in our case, we've managed a trust company in the past. We decided to do the same thing, so we went down a couple-year process. It's a pretty rigorous review and approval process to get a trust company charter. So we're now licensed, regulated, and audited by the Division of Banking in Wyoming. And that means we're licensed, we're regulated, so we have to follow their stringent requirements. We have minimum equity capital requirements, minimum bonding requirements, and then we're subject to an annual audit. So all of the client accounts go through that annual scrutiny of the Division of Banking. So that's one of the big ways we set ourselves apart, is if something goes wrong, all of the funds are held by a trust company. They're clearly client trust funds, not corporate funds. And the state would come in, take us over, and continue running the entity and probably find another trust company to take over. So that's one of the big ways we've actually differentiated ourselves. Secondly is we're more advisory, more consultative. A lot of qualified intermediaries or processors. In today's world, these transactions get really complicated. So you need somebody who can work with the client and their advisors to walk through the process, look for potential problems, identify those issues, and fix them before they become permanent.
And that's a big deal. I mean, not that I'm railing on some of the competitors there, but I've done 1031 stuff, and if that group doesn't completely understand, if the person at the end of the phone's more than likely a call center, you're usually talking to. If they don't completely understand what they're doing, it could really set you back. It's usually a big mistake that they're not paying for, you are, right? So it is really important to align yourself with someone that knows what they're doing. It's a real big deal. This is a real big deal.
Absolutely, yep. And that trust capability is critical. A lot of people probably don't remember, but in 2008, Land America, which is one of the largest title, escrow, and qualified intermediary companies, they were either number 4 or number 5, I think, in terms of transaction volume and size. They failed with the 2008 recession. And the judge ruled that the client funds were actually corporate funds because they were held in the corporate name. And he also said, had you used qualified trust accounts or qualified escrow accounts, I would have ruled differently. We've used qualified trust accounts forever because of that, and we knew that would happen. It just most people were shocked by it. But it's critical to have your funds held in a qualified trust account or qualified escrow account.
I mean, and I don't know if they did that on purpose or what. I mean, it sounds very shady, though, doesn't it? I mean,
yeah, I think the unfortunate thing in this case is I think they were thinking we are too big to fail. I mean, they're one of the big 4 or 5. And people, the sales team would tell people that you should use us because we're too big to fail, and then they failed. And it wasn't misappropriation of funds or anything like that. They invested the client funds in something they shouldn't have invested them in. They're not bad investments. They're just not prudent for 1031 exchange funds. And when you hit a recession, the market they invested in completely froze, and they couldn't get the money out. So it kind of forced them into this really awkward situation, and then ultimately took them down.
Wow, that's scary stuff. I mean, that's why now more than ever, who you align yourself with is absolutely critical. Whether it's your 1031, your title company, because title can happen the same thing with title companies as well. I was talking to someone the other day about that. It's like whether you choose to work with a large national or international title company versus a small group that that only does single families. Nothing wrong with those guys. I'm sure they're nice people, but sometimes you have to worry about that. So it's you got to cover your bases, right? You got to cover your bases. Absolutely.
Yep. It's all about getting the right team together that has all the components you need.
Yep. That's right. So we covered a lot of stuff here today when it comes to 1031. What sort of bulletproof advice would you offer to someone listening right now?
Good question. I think I'd go back to the comments we made before. Make sure you got your team together and use them. Talk to the advisors, and that will prevent things happening that you could have prevented. The big one is your legal and tax advisor, because they're going to review things and try to protect you. The next step is, you get a lot of people who go, I want to get into real estate. Don't give up. Be persistent. I've seen so many people who try and then they give up and walk away. And sometimes it takes a couple of years or more to break into whatever industry or niche you're looking to do. So don't give up. If that's what you really want to do, be persistent and keep going at it.
Yep. No, I agree 100%. I mean, especially for those folks that, maybe you can't find a deal yourself. Partner up with someone that does. We have some great deals that we do. We only do good deals at cash flow. We strongly believe in them. We don't do high risk stuff. And you know what? It's not, these are types of deals that are not available to just anybody. So it's why not partner with somebody? If you really want to get in, it's a good way to get exposed to real estate. It's a great way to get exposed to real estate. So, yes, excellent. Great advice. And you have some stuff on your website too, right?
We do. We've got a lot of information out there. You can go to our our library. There's a lot of articles that you can read on specific topics for 1031 exchanges or self-directed IRAs, etc. We have a guidebook on 1031 exchanges. We have a quick reference guide on 1031 exchanges. You can also just email us and we'll email you the links to them if that's easier, or you go to the website and just search for them. But it's all free. You can download any information you want to help kind of walk through the process. And then really after you read all that, it's still confusing. So, feel free to call us and we'd be happy to chat.
Excellent. All right, guys. Well, if you want to reach out to Bill, you can reach him via his website at Exeter 1031. Again, we'll include a link in the description. Covered a lot of stuff here on 1031 exchanges. And like Bill just pointed out a second ago, a lot of good information out there on the website. If you do have questions about a 1031 and what it is again, after the show, of course, feel free to reach out to Bill's team. They'll be very happy to help you out. This is one of those critical aspects of real estate that will certainly help in really securing the work that you've been doing on really building your portfolio of real estate. This is one of the best ways you can to protect it. Thanks for tuning in. I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.